Hello everyone, this is Bhavik Chokshi over here. Hope you guys are doing well and studies are going in full flow. So this video is a very short video to share with you the compiler for paper number 5 CA Inter Advanced Accounting. So this is for only the theory. This is dedicated to the theory. This is something which is generally ignored by the students at the time of your preparation, but come exam day, this is one thing which leaves a lot of uncertainty. So what we have done is we have tried to compile everything from the new syllabus RTPs, MTPs as well as exam questions, as well as in the old syllabus the relevant topics which are common with new, the RTPs, the MTPs and the exam questions for old and new. So probably this will give you, this is around 20 odd pages, and we'll quickly invest some time, probably half an hour to slightly more than that. We'll invest that and try to finish this in the video. Otherwise you can go through it. We'll also highlight and mark the keywords so it's easier for you to remember. So let's get started over here. This is for paper number 5 for the new syllabus. Old syllabus, whatever is common with new, we have incorporated the questions. It's a compiler of all RTPs, mock test papers, exam papers, and we have also taken some relevant questions from the practice manual which are relevant. So this is around 20 odd pages and should kind of help you in your theory. So the next page you have around the index. We have taken the topics that we have incorporated over here, and then I've given you the list of past exam theory questions. So just to be absolutely sure, in each and every attempt in the new syllabus, you have had a weightage of 5 marks, and that is it. So out of your total paper of 100 plus 20 marks as options, 5 marks comes as theory, and hence we have to kind of balance the amount of time we invest over here. It's not that we should leave it, but we should balance the amount of time. So as you can see, attempt wise we have given the weightage 5 marks, 5 marks, 5 marks. Actually in November 19 there was one question for CRR, but there was actually a numerical sum also over here. But other than that, what are the questions? There was one question on how MAT is to be presented, minimum alternative tax. How should the initial disclosure requirements of AS24 be in case of discontinuing operations? A distinction between amalgamation, absorption, external reconstruction should be manageable, and criteria for recognition of income in case of NBFCs. This is in your new syllabus till November 19. Now, as you would be aware, even partnership dissolution has been added. That was a favorite for the institute in the old syllabus, where the May 18 question as well as the November 19 question was on LLP, limited liability partnership, which is also there in your new syllabus study material. There will be no sums dedicated to LLP. There are sums on dissolution, there are sums on amalgamation, but no dedicated sum for LLP. Well, what applies to a regular partnership may also be taken for LLP or a company, as the case may be. So over here, 4 marks of LLP questions where we also incorporated now, because it is likely that a question on LLP would come in your, may come rather, in your exam. So let's get started. Let's be quick. We'll quickly run through the questions. There are around 38 questions over here. A lot of these you would be aware. Around 20 sides, 20 to 24 sides if you remove the index and stuff. That's around 20 sides and around 38 questions. Probably invest half an hour right now and get done. Just glance through it once and sit for the exams, get your 5 marks and proceed. Okay, so let's start over here. The first question, this is, we are dealing with partnership accounting standards we have kept at the end, and even in accounting standards we have taken selected theory questions from MTP, RTP, etc. I have given the source. If you go to see question number 1 at multiple places, MTP is a mock test paper, RTP is a revisionary test papers, and if there's an exam paper, we would have written ICAI. So question number 1 is, explain the nature of limited liability partnership. Who can be the designated partner? See, limited liability partnership, remember, is different from a general partnership. It is like a company. An LLP is like a company. It is a body corporate, has separate legal existence. So over here, it is a body corporate. It has separate legal existence. You have to remember that. And the liabilities of partners are limited, unlike a general partnership where it is unlimited. What is designated partners? Well, every LLP has to give a minimum 2 designated partners, out of which one of them has to be a resident. If your partners are body corporates, then they have to nominate an individual who can be a designated partner. So 2 designated partners, and at least one of them shall be a resident. So this is about it. Then you go to question number 2, which is differentiate between an ordinary partnership firm and an LLP with respect to the applicable law. The law over here is for the general partnerships. It is a Partnership Act of 1932, And for LLPs, it is the LLP Act of 2008. So you just have to kind of remember these years and the name of the act. The number of partners, again, minimum partners are 2 at both places. For a general partnership, there's a maximum limit of 20 partners, I guess 10 for banking companies, but otherwise 20 in general. For LLPs, there is no such maximum limit. So over here, minimum 2, but no maximum. Here is minimum 2, maximum 20. Ownership of assets. So general partnership is not a separate legal entity, and hence assets are held on behalf of the partners. But LLP is a separate legal entity, and hence it owns assets in its own name. So over here, it can own assets. So over here, the partners own the assets. And lastly, the liability, as you would be aware, liability in case of a general partnership is unlimited. In case of LLP, it is limited. So these are the 4 important points. Then you go to the next question. Explain the provisions relating to the liability of LLP and its partners as per LLP Act. The general rule is the liabilities of the LLP are the liabilities of the LLP only. They don't extend to the personal assets of the partners, unless partners have done something which is fraudulent or something which is beyond the scope of the LLP, in which case the liability becomes unlimited. Otherwise, the liabilities of an LLP shall be met out of the properties of the LLP only. A partner is not personally liable. Then an LLP is not bound by anything that a partner has done if the partner acts beyond his authority and the other party is aware that the partner is acting beyond his authority. Then it does not bind the LLP. And the liability of LLP and the partners perpetrating fraudulent dealings shall be unlimited. Only in case of fraudulent dealings shall this liability become unlimited. Okay, then what are the circumstances when LLP can be wound up by the tribunal? This has even been asked in the old syllabus. One of the 4 marks questions in November 19 was this. Now that it is in the part of your intermediate paper 5, it is important. So over here, see, this is ICI November 19. This has been asked. So when can an LLP be wound by the tribunal? Various reasons. When the partners themselves decide that the LLP should be wound out by the tribunal, or there have been 6 months and there has been only one designated partner. You have not been able to kind of get another designated partner. So if LLP decides, and second case, if more than 6 months, the number of partners is reduced below 2, maybe death or any reason. In such cases, LLP is unable to pay debts. It acts against the interests of the country. It has defaulted in filing the statement of accounts. Remember, for a period of 5 consecutive years. Though time limited, one is 6 months, there's less than 2 partners. And secondly, for 5 years consecutively, we have not filed the statement of accounts and solvency. And the last one is an open-ended thing, where if the tribunal thinks it is just unequitable, it can wind up. Then we have a short note on the designated partner and explain his liabilities. This is something that we have done, as mentioned earlier. At least 2 designated partners, of which one of them have to be the resident. Body corporates, if partners, have to nominate a designated partner. Liabilities are restricted to the liability. His personal contribution is to be involved unless there are certain fraudulent transactions that have been undertaken, when the liability becomes unlimited. Otherwise, the designated partner is responsible for filing documents, etc. for the LLP. Penalties. He would be liable if he is in violation of the terms. Then you have Garner versus Murray rule. You would have done this, but as a part of theory. When does Garner versus Murray apply? If there is one partner, or there are certain partners who are insolvent. In such cases, remember, the profit or loss on dissolution is always attributed in the profit sharing ratio. However, if there is an insolvency loss, when there is a partner who is insolvent, that insolvency loss will be shared among the remaining solvent partners in the ratio of their capitals. Over here, if it is a fixed capital, in which case no adjustments. If it is a fluctuating capital, in which case you will have to take all the adjustments except the profit or loss on dissolution. You will take all the other adjustments and find the ratio of capitals for the Garner versus Murray. When does this not apply? Well, if a solvent partner has a debit balance. If a solvent partner has a debit balance, this does not apply. Solvent partner who has a debit balance, this rule does not apply. When the firm has only 2 partners, well, there's no question of allocation. If one of them is insolvent, everything else is to be borne by the other partner only. And if there's an agreement between partners, well, that will override the Garner versus Murray rule. If there's no agreement, then Garner versus Murray applies. And lastly, if all the partners are insolvent. then this rule does not apply. So these are the theory questions largely linked to LLP and a question on dissolution for Garner versus Murray. For ESOP, there has been one question in the mock test papers of the new syllabus on graded vesting. What do you mean by graded vesting? Vesting that happens over years. For example, almost every question that you have studied in your syllabus would involve options having, let us say, a vesting period of fixed years, let's say 3 years, let's say 5 years. But a lot of times, successful ESOP, if you tell someone to work for 3 years, he does not get as motivated. But what you can do is you can throw the carrot to the employee for a much more faster result. So for example, I had to give 100 options. Rather than fixing the vesting period for the 100 options as 3 years, I can say that, well, 100 options will vest. Well, if you work for 1 year, let's say 20% of these options, that is 20 options will vest. If you work for 2 years, another 30% of these options, let us say 30 options will vest. And if you work for 3 years, the remaining 50% of the options, that is 50, will vest. So over here, you are retaining the employee. So for example, if he gets very agitated and he wants to leave the company, he will say, yaar, aur thoda main reh jata hu, I will get 20 options. And so that is how you will retain the company. If you give him a carrot for 3 years later, he might not be as motivated to continue. He might leave midway. This is what is graded vesting. The vesting does not happen directly at 3 years. It happens in a graded manner. So this is for theory. Now you might wonder that what if this comes in a sum? It's very easy. You will treat each of these plans as separate plans. You will treat as if the company has announced 3 separate plans and find the employee compensation expense for each of these plans. 20 options with a vesting period of 1 year, 30 options with a vesting period of 2 years, 50 options with a vesting period of 3 years separately. That is what graded vesting is. So this is graded vesting. In this case, the options do not vest on one date but have graded vesting schedule. Total plan should be segregated into different groups depending upon vesting dates. So this is the only thing that you have to remember here. Otherwise you can write if you understand. What is employee stock option plan? This is generic, and explain the importance in modern time. Well, this is a broad theory question. So ESOP, as you would be aware, is a plan where if employees fulfill certain conditions, the company gives them an option to buy shares at a slightly cheaper price. This motivates the employees. They become part owners of the company, and hence it helps them to stick around with the company for a slightly longer period, and it creates long-term wealth in the hands of the employees. So a generic question which was there in the older practice manual, that is on ESOPs. We'll just try to quick, and hence I'm trying to kind of wrap this up because I don't want to take a lot of time, your valuable time at this stage of your exams in the theory part. So quickly going through this, you can always glance through the notes over here. They will not take more time. Rather than leaving everything, it is important that you just glance through the important points. Then is buyback and shares with differential rights. Explain the meaning of equity shares with differential rights. Well, the rights here can be different with regard to dividend, can be with regard to voting rights or any other case. So this is rights which differ for dividend, voting or otherwise. Can preference shares also be issued with differential rights? The answer is no. It is only, this section only applies to equity shares, not to preference shares. Explain conditions under Companies Act to deal with equity shares with differential rights. Remember, this has to be first permitted by the articles. So the articles should permit this. Second, the maximum amount that you can issue is 26% of the total capital, total paid up capital of the company. So the limit over here is 26% of the total share capital can be shares with differential rights. It has to be authorized by an ordinary resolution passed at the general meeting. So I'm just highlighting the important keywords so that you just remember them. Which companies can do that? Well, companies which have a clean record, they have distributable profits in the last 3 years. Distributable profits. It is not necessary that you have distributed dividend, but profits hone chahiye, which are capable of being distributed in the last 3 years. Company has not defaulted in any filings, in any payments of debts, in payments of interest, in anything. So in the last 3 years in general, there should be no defaults. Not defaulted in filing of financial statements, no subsisting default in payment of a declared dividend, not defaulted in payment of dividend on preference shares or repayment of any loan, and the company has not been penalized by a court or tribunal. So basically a clean company. the general things that you have to remember for a 4 or a 5 mark question is, first, it has to be authorized by the articles. Second, an approval is to be received from the shareholders through an ordinary resolution in the general meeting. Third, the maximum size is 26% of the paid up share capital. Fourth, a clean company. And when I say a clean company, it has regularly filed the financial statements in the last 3 years, no default. It has not defaulted in payments of dividends, not defaulted in payments of preference dividend, not defaulted in payments of any loans, and should not be penalized by court or any tribunal. Okay. What are the conditions to be fulfilled for buyback? This you would have definitely done as a part of your sums. The earlier differential rights, there are no sums on this part of the theory. It was just theory and hence it could come. Buyback should be authorized again by the articles. It has to be authorized by the articles. The maximum limit of buyback is 25% of the paid up share capital. The amount that you can spend for buyback is 25% of the paid up share capital and free reserves. The debt to equity ratio after buyback cannot exceed 2:1, and the number of shares that you can buy back are 25% of the share capital. The only exception is all of these can be done if you have a special resolution from the company. Well, if you don't have a special resolution, through a board resolution, 10% can be bought back. But if you want to buy back more than 10%, up to a maximum 25%, you can buy back through a special resolution. Otherwise, 10% through a board resolution. Otherwise, you will have 25%. You will have 25%, and the debt to equity ratio should not be more than twice the total paid up share capital. Apart from that, only fully paid shares can be bought back. And once a buyback is done for the next 12 months, similar type of securities again cannot be bought back. So they have to be fully paid, and if they are listed, SEBI rules have also to be complied. No offer of buyback shall be made within a period of 1 year. So these are the important points that I've kind of highlighted over here for your reference. Then comes the next chapter on amalgamation and absorption. This is one of the exam questions, a bonus question, I would say. Distinguish between amalgamation, absorption, and external reconstruction. Obviously, what do you mean by amalgamation? Amalgamation would mean naturally A and B closing and a new company AB coming into existence. So there are basically at least 3 parties in case of an amalgamation. In case of an absorption, A is closing and going into B. So even 2 parties are enough for an absorption. And in case of an internal reconstruction, there is A and it closes and it rebrands itself as, let us say, new A. Generally, amalgamations and absorptions are done to increase your market share competition, whereas external reconstruction is more of a reorganization exercise, a restructuring exercise. So the objective of amalgamation is to cut competition, and same is the case with absorption, but for external reconstruction is reorganization. Resultant companies, only one resultant company is formed. Over here, absorption, no new resultant company is formed. And in external reconstruction, also a new resultant company, which is basically a rebranded company. Minimum number of companies, as we have said, for amalgamation it is 3, others are 2. And the first point is the important point where we are trying to understand the meaning for each of these. So this was for 5 marks that had come in the exam. Then the next question, which is a mock test paper question, which is the difference between pooling of interest and purchase method. Pooling of interest arises when amalgamation is in the nature of merger, when certain conditions are satisfied, in which case you will take over all the assets and liabilities at their book values. Reserves will also be taken over, and the balancing figure, if any, will not go to goodwill. Instead, it will be adjusted directly against reserves, general reserve, for example. On the other hand, in case of a purchase method, all assets and liabilities are taken over at fair value. Reserves are not taken over. It is just that statutory reserve can be created. And the difference between purchase consideration and the net assets is adjusted against goodwill or capital reserve, as the case may be. This is something which you can write even without reading this theory, something which you should be aware of. Then comes liquidation. There are a lot of theory concepts that can come in liquidation, though you have not really got even a single question on liquidation till now. So a lot of things like B-list contributories, what is the statement of affairs of a liquidator, what are the various lists that are there. So I will just quite quickly go through. First, B list of contributors. What is B list of contributors? If on liquidation, we don't have enough money to pay off all the stakeholders, in which case the liquidator will go to those shareholders who have transferred their shares in the last 12 months, other than by reason of death, etc., who have transferred shares in the last 12 months. and try to recover the liabilities that were existing as on that date proportionately to the maximum extent of their unpaid value. These are called as B-list contributories. Remember, they will come into existence if and only if the liquidator does not have enough money to pay off the stakeholders now, and a transfer of these shares have been made in a period 12 months earlier, and the liquidator cannot recover that money from the existing shareholder. Then to the extent of the unpaid amount, the liquidator will approach these B-list contributories and will try to recover the amount maximum to the extent of that unpaid amount, taking the liabilities that were existing as on that date. There are a couple of very interesting sums that we would have done, even there in your module, even there in our books, where we have done the allocation for B-list contributories. What are the contents of the liquidator statement of account? How frequently does a liquidator have to submit such statements? Well, contents, there is receipts and there is payments. So this is not something, this is a statement. It is not really a balance sheet or a profit and loss account. It is a statement where you show receipts on one side. Receipts may be on account of sale of assets. If there are secured assets, then only the surplus we take over here. Calls or contributions received from the contributories, all of these are taken on the receipt side. On not the liabilities, but on the payment side, you would take the legal charges, in the order, legal charges, liquidators' expenses, debentures. Now, actually, preferential payments come first, but debentures are taken first over here. Preferential creditors, as you would have done this in sums as well. Unsecured creditors, preferentials, and lastly with equity shares. This is to be prepared annually. In case winding up goes on for more than a year, then they have to give this statement on an annual basis. What are the lists? The next question is, what are the lists that a company should prepare? Well, there are lists up to H. A is assets secured but not specifically pledged. B is secured and specifically pledged. So here we find the surplus or deficiency. So these are two for assets, then goes to liabilities. List C is preferential creditors. D is debenture holders who have a floating charge. E is unsecured, the big list of unsecured creditors. F is preference shares, E is equity shares, and H is the deficiency or surplus, where you explain also the reasons for deficiency and surplus. Okay, next you have banking companies. Over here you have CRR. CRR is the amount that you have to keep in cash, either direct cash or in current account with the RBI. The current CRR ratio is 3%. You have to remember this, and this is kept in cash, ready cash, or in current accounts with, so this is either kept as a cash reserve with itself or a balance in a current account with the RBI. This is CRR. Then comes SLR. What do you mean by SLR? SLR over here is this reserve that you can keep in the form of cash, gold, or even unencumbered securities like government bonds. So these are like government bonds, gold and cash. This is around 18% of the net demand and type liabilities. Both of these, CRR and SLR, are kept in order to have a strong position. So this is about SLR. What is meant by rebate on bills discounted? Typically, bills discounted, bank would earn an income, and this income is taken as income in the P&L. However, it might happen that this income on bills is to be recorded over the tenure of the bills, and it is possible that the maturity date is after the balance sheet date. So like an unearned revenue or an unearned income account, you'll open the rebate on bills account. So over here, the portion of discount which relates to period falling after the close of the accounting period is called as a rebate on bills discounted or unearned discount account. Short note on slip system and double voucher system. This is just a generic point. Slip system is when the records that you maintain is directly through the slip that the customer fills in. So for example, if you have gone to banks to deposit checks or withdraw cash, etc., the customer fills a pay-in slip. There are two copies. One is a copy that is with you. One is a copy that goes to the banker. In the slip system of posting, you will directly post from the slip that the customer gives. But in the double voucher system, there are two separate vouchers prepared and posting done separately by two people. This is for better internal control. So over here, this system is called double voucher. What is in a bank? Two vouchers are prepared for every transaction, debit and a credit voucher. This is designed to increase the internal checks. Under this system, slip system, entries are made directly from the customer filled vouchers only. Achha, what are the restrictions imposed by Banking Regulation Act on the payment of dividend? So the dividend over here can be paid, but this is after writing off all expenses. Like if you have any unamortized expenses like preliminary expenses, share issue expenses, etc., all of these will be written off. And after that, if you have profits, then you can pay dividend, otherwise not. It is fine if the investments have depreciated or the value of investments has fallen and you have created a provision, let us say for standard, substandard assets, and even after that, the value of investments has fallen further, it is fine, you can still give dividend, that is fine. However, the only restriction that Banking Act says is all the losses or expenses have to be written off, and then only can a dividend be paid. Classification of investments by banking company. Remember, there are three classifications: held to maturity, as the name goes, investments to be held up, intended to be held up to maturity; held for trading, intended to be bought and sold within a period of 90 days; available for sale, investments which do not fit any of the first two criteria. For example, there's a 5-year bond. We don't want to sell it after 90 days, but we don't even want to hold it for 5 years. We want to sell it after 3 years. Then it is available for sale. So these are the three categories. A transfer from one category to other is possible subject to certain limits and permission secured from the board. Then you have non-performing assets. What do you mean by non-performing assets? These are generally for banks amounts which are overdue beyond 90 days, that is 3 months. So there can be a lot of things like interest or principal amount overdue, or a bank overdraft for cash credit remaining out of order, or a bill remaining overdue. There can be many things, but a general thing that you have to remember is if the overdue is greater than 90 days, in general, in case of banks, this is considered to be a non-performing asset in general. Okay, then the short note on classification of advances by banking companies. Well, you have standard assets, substandard. So standard assets has no problem. So in case of standard assets, there is no problem. In case of substandard assets, this is something where it is an NPA of NPA up to 12 months. It is an NPA, and as on the balance sheet date, less than 12 months have passed. Over here, this doubtful is it remains substandard. It remains substandard up to 12 months, or it is actually substandard up to 12 months. After 12 months, it becomes doubtful. And loss assets is something where a loss is clearly identified. So if we were to kind of say standard assets do not disclose any problems, substandard assets, one which has been classified as an NPA for a period not exceeding 12 months, doubtful asset is one which has remained substandard for a period of at least 12 months, and loss asset is one where loss has been identified by the bank or auditors, as the case may be. Okay, so obviously your provisioning depends on the provisioning percentage, kind of depends on where the classification is. Mention the condition when a cash credit or an overdraft account is treated as out of order. When is it out of order? Remember, overdraft and cash credits have limit, sanctioned limit. Let's say beyond this, your overdraft cannot go. Let us your overdraft goes beyond that, then it is considered to be out of order. So that is the first possibility. The outstanding balance remains continuously in excess of the sanction limit. That is when it is out of order. Acha, let us say the sanction limit is 1 lakh and your overdraft is 1,50,000 and it continuously remains that, it is considered to be out of order. Second, if let us say your overdraft is less, it is 50,000, your sanction limit is 1 lakh. However, you have received no credits in the last 90 days and you do not have even balance which is sufficient to pay the interest. So there are no credits continuously for more than 90 days as on the balance sheet, and credits during the aforesaid period are not enough to, or the credits that have received are not even enough to cover the interest during that period. That is when it is considered to be out of order. Okay, that takes care of banks. Then we go to NBFCs. NBFCs, the exam question that had come was income recognition. Abhi apan buddhi lagai ki apan bole ki November 19 it has come, so it will not again come. Please do not apply such unique thoughts. Chota sa 20 page ka theory, please read it. So income recognition, remember, in case of the moment an asset, even for an NBFC, becomes an NPA, income will no longer be recognized. It will be recognized only when it is received. Income recognition shall be based on accounting principles. In normal, that is accrual basis as and when time passes. However, interest on any other charges on NPA shall be recognized only when it is actually realized. Otherwise, it will not be recognized. In respect of hire purchase, if for a period of 12 months you have not received anything, then income recognition will only be on when higher monies are received. Similarly, for leased assets, if the overdue amount continues for 12 months, we will recognize income only when actually received. So in respect of hire purchase assets, when overdue of more than 12 months, income should be recognized only when hire charges are received. Same is for leased assets. If overdue is more than 12 months, income shall be recognized only when lease rentals are received. I'm just doing all of this slightly quickly so that we kind of try to cover as much as possible in the least amount of time possible. Okay, write a short note on earnings value of equity share as per NBFC. So just remember, this is calculated as the PAT minus preference dividend. This is calculated as PAT minus preference dividend divided by a particular capitalization rate. So this is divided by capitalization rate. Capitalization rate is taken as 8% for manufacturing companies. Capitalization rate. अच्छा, capitalization rate में क्या हो सकता है? This can be either 8% for manufacturing companies, 10% for trading companies, and 12% for every other companies. And this numerator is average for the last 3 years. That value that you will get, the average profits for the last 3 years after deducting preference dividend divided by an appropriate capitalization rate, will give you the earnings value. Okay, then you have non-performing asset for NBFCs. Again, typically over here you have the general rule that you have to remember is there are two types of NBFCs. There is NBFC ND, SI, that is non-deposit taking NBFCs of systematic significance, and NBFC ND, which is not of systematic significance. So over here, the general rule, I think we have to take this on the other side. The general rule is if it is NBFC ND SI, this is of systematic significance, or NBFC D, आपको ध्यान रखा, these are deposit taking NBFCs, or ND is non-deposit taking, D is deposit taking. If it is non-deposit taking, then of a systematic significance, that is more than 500 crores of net worth, then the criteria is 3 months. For your exam, it is 3 months. Anything which is overdue greater than 3 months is an NPA. For a non-deposit taking NBFC ND, so this is non-deposit taking, which is not of a systematic significance, in which case this is 6 months. ये आप दो चीज याद रखो, हर एक में same है. So it is like banks only. You look at bills, you look at loans, you look at interest, but the time limit greater than 3 months, overdue greater than 3 months, then it is NPA. In case of the bigger NBFCs, the systematic significant ones with more than 500 crores of net worth, if they are non-deposit taking and deposit taking always. And for NBFC ND, it is 3 months. So as you have written over here, as it is written over here, ये वाला important point है. काफी सारी चीजें. Any dues as per NBFC systematically important, non-deposit taking NBFC and deposit taking regulations. The above 6 month criteria for assets covered in A2F is 4 months for financial year ending 31st March 17. वो हमें लेना देना नहीं है. And from the next year, it will be 3 months. So we are giving the exam in the year 1920 and it is now 3 months. If you see ahead, हर एक जगह यहाँ पे आपको लिखा रहेगा interest has remained overdue for 6 months. Principal term loan overdue for a period of 6 months. This is all from point A up to point F, 6 months for a non-deposit taking NBFC, which is not systematically significant. It is around greater than 3 months for a deposit taking NBFC. A deposit taking NBFC and a non-deposit one with systematic significance. If you are aware, even while solving sums, 0.25% is the provisioning limit in case of the non-deposit taking NBFCs, which are not systematically significant, and for the deposit taking ones, and for the NBFC NDSI, it is 0.4%. If you remember, we would have done this in sums as well. Next is a schedule 3 or guidance note. There's one very popular question on how minimum alternative tax is going to be accounted. minimum alternative tax will be done, I guess, under final CA, that is section 115 JB. This is a tax which is paid on book profits. You would have a faint understanding, I guess, by this stage of MAT. Remember, MAT is paid as a percentage of book profits, not on income tax profits. Book profits are calculated as per section 115 JB. So if your MAT comes to 500, whereas your income tax comes to 200, you have to pay 500. And hence, in your profit and loss account, 500 will be shown as an income tax expense. So is your real tax 500? No. For the 300 rupees, you get a MAT credit, which is I think around 10 to 15 years. Under Income Tax Act, you get a MAT credit. And hence, this is like a prepaid tax. And hence, the standard, the guidance note tells you that the 300, if it is expected to be realized, then this 300 that you are overpaying can be shown as a prepaid tax under the heading of loans and advances, non-current assets, long-term loans and advances in the balance sheet. So what will happen is, in your profit and loss account, yes, your expense will be shown as 500 because you've paid MAT of 500. At the same time, 300 you will show as an asset with a corresponding credit against the P&L if you're creating a deferred tax for this, but otherwise it will be shown as an asset in the balance sheet under the heading of non-current assets, long-term loans and advances. Whenever the MAT credit is utilized, you will debit the provision for tax, because in the subsequent years it might happen that your income tax is 400 and your MAT is 200. Then you can utilize, ideally you have to pay 400, but you will say that, well, I will utilize my MAT credit which was of 300 to the extent of 200 I will utilize, and hence your MAT credit will be reversed, your asset will be reversed, and correspondingly your provision for tax will also be reversed. So over here, this is a very popular question, the presentation of MAT in the financial statements. I would strongly recommend you read this. Balance sheet, MAT credit is allowed to be recognized as an asset under the heads of loans and advances. In the year of set-off of credit, the amount of credit availed should be shown as a deduction from the provision of tax on the liability side of the balance sheet. So double entry, provision for tax debit, MAT in the long-term loans will be credited. Profit and loss, the MAT is current tax. You will record that as an expense. The tax expense arising out of payment of MAT should be charged as a gross amount in a normal way. In the year in which MAT credit becomes eligible to be recognized as an asset in accordance with the recommendations contained, the credit to the statement of P&L should be presented. So for example, if I were to put journal entries so that it is amply clear to you, I think these formats have slightly gone off track in the last two pages. So let's just kind of discuss this. Let us say over here, agar hame MAT ka entry pass karna hai, let's say accounting standards, we'll write on the next page. So let us say these are accounting standards. A few simple questions over here. We'll just quickly wrap that as well. So let us say in year 1, your income tax was 200, MAT was 500, you will have to pay 500, and 300 will be the MAT credit. So your journal entry would be, or let us say in the P&L, if I put it in the P&L and in the balance sheet, your journal entry will be income tax expense is 500, that is based on MAT. So this is your tax expense based on MAT. To, let us say, bank if you have actually paid it, and then you'll have to recognize a MAT credit. So MAT credit recognized in the balance sheet as loans and advances worth, let us say, 300, and samne uska double entry, so MAT credit account debit to income tax expense another 300. So this will be subtracted and the net expense of 200 will be recorded. In the next year, when you, let us say, utilize the MAT, so let's say in year 2, your income tax liability comes to be 600. And your MAT comes to be, let us say, 300, in which case this 300 of credit can be utilized. And in the next year, when your provision for tax is actually 600, your journal entry will be provision for tax account debit 600 to bank, let us say 300 to MAT credit 300. And your income tax expense will be full 600 in the second year. I hope I have been clear in this. So this is an important point, question number 2. And when we look at question number 1, it's an interesting case. So over here, what is happening is you have invested in a convertible preference share, and this is going to be converted in a period which is less than 12 months. So typically, if you are going to receive cash or cash equivalents in less than 12 months, then it is considered to be a current asset. So the question arises that yes, if it is a redeemable debenture or a redeemable preference share, yes, you will receive cash. However, if it is a convertible preference share, then you are not going to receive cash. instead of receiving cash, you will receive equity shares of the company, and that is not cash, and hence the appropriate classification should be non-current. So let's read this question. How will the company classify its investments in preference shares which are convertible into equity shares within 1 year from the balance sheet date? Will it classify the investments as current asset or non-current? The answer is non-current. So such realization should be in the form of cash or equivalents rather than through conversion of one asset to another. Hence, the company should classify this as a non-current asset. So this should be classified as a non-current asset. Are we clear with this? Okay, so this is a non-current asset. So here we have schedule 3. It's actually printed on the earlier side. And then is accounting standards. Related parties is remuneration paid to the board of directors a related party transaction. Well, if the directors are having responsibility of planning, etc., which is KMP, key managerial personnel, typically the executive directors are key managerial personnel, and payments made to the executive directors like managing director, whole-time director are related party transactions, but payments made to independent directors, non-executive directors are not considered to be related party transactions. Okay, this is general. Otherwise, if nothing is specified, then we'll assume that directors are responsible for planning, and hence it can be considered to be a related party. Then we have the concept of weighted average number of equity shares. This is a time-based weighted average depending on the number of days for which these shares are outstanding. That number of days you take as the base. Then while calculating diluted EPS, effect is given to all dilutive potential equity shares that were outstanding during the period. Explain in light with the relevant standard. Well, potential equity shares are those shares which have the potential to become equity shares like convertible debentures, bonds, etc. And as a result, if you have the potential, then they can increase your share capital and as a result reduce your EPS. So they have to be considered if they are dilutive, that is they reduce the EPS. Next you have AS22, timing differences and permanent differences. Timing differences are those differences which create in 1 year and will get reversed in the future years, like depreciation, like section 43B items. Permanent differences are those differences which are created but they do not reverse in the subsequent years. That is permanent differences. You create deferred tax on only timing differences, not on permanent differences. And then you have discontinuing operations. First, it is mentioned what do you understand by discontinuing operations. Basic theory. It is a component of an enterprise which as a part of a single plan, is a component of enterprise. This is important. Which as a part of a single plan you are planning to dispose of in its entirety, like a slump sale, or on a piecemeal basis, or terminating or abandonment. So this is either terminating or piecemeal or substantially in its entirety. That represents a separate major line of business or geography, like a segment, and can be distinguished operationally and for financial reporting purposes. You have detailed data separately for operations as well as financial reporting. The only theory question that has come for accounting standards, theory question, not a case, is the one that had come in November 2018. What are the initial disclosure requirements of AS24 for discontinuing operation? So let us say if it is classified as a discontinuing operation, then what all should be shown in the financial statements? Well, a description on what is the nature of the operation, the segments, if at all AS17 report was prepared, the date and the nature of the initial disclosure event. We had studied that this is a date which is usually the earlier of the date when the public announcement is made or a binding sale agreement is entered. The period for which the discontinuance is expected to be completed. How much time does it take? For example, just a Future and Reliance are happening. Future ka operation band ho raha hai, but it is still not handed over to Reliance. So there might be some time. The carrying amounts in the balance sheet, the revenues and expenses pertaining to the discontinuing operations, the pre-tax profit from the discontinuing operations and the cash flow. So these are financial impacts. So ये आपका पूरा financial हो जाएगा. This is the financial part. You can say this is the balance sheet. This is the impacts of the P&L, revenue expenses, and this is the cash flow. And उसके पहले the descriptive part on what is the date when it starts, when is it expected to get over, what is the description of the operation, etc. Give 4 examples of activities that do not necessarily satisfy the discontinuing operations. So over here the examples can be a gradual phase off. So if you are making Maruti 800, you are reducing the quantity of Maruti 800 and increasing the quantity of Maruti Swift. That is not a discontinuing operation. or let us say you are just relocating to another geography for better production or better let us say supply chain management. So this is phasing out of a product, is not discontinuing operation. If you are reducing one product, increasing another product, shifting of some production, let's say from China to India, not discontinuing operation, and closing of a facility to achieve productivity improvements. These are not considered to be discontinuing operations by the mere fact of it. Okay, and then lastly is a distinction between contingent assets and liabilities. Obviously, a contingent liability is something where there is a possibility that you might have to make a payment, a possible obligation arising out of events which have been done in the past, but the outcome will be known by certain investigations or court orders, which are future events which are beyond your control. Typically, contingent liabilities are disclosed if they are uncertain and they are accounted in the books if they are probable. Contingent assets on the other side as are the benefits that you are going to receive, but they are still uncertain. Outcome will be dependent on certain future events which are beyond your control. And hence, contingent assets should not be recognized in the books till the time they are virtually certain. Otherwise, they should be merely disclosed. So I hope this session has been helpful to you, and I'll wish you all the very best. Study hard, do well, and let us know if you have any queries. We would try to help to the best extent possible. Okay, I will be sharing the link for this in the description. You can take the notes from there. Okay, goodbye, good luck, see you.